Hello and welcome to episode 515 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leaks. Damien, welcome back. How are you doing?
I'm great, and thank you to everybody who's listening who left comments on Spotify for us, or for me, to go and give the thumbs up and reply to. There were a few of you. There should be thousands of you doing it each week, so don't forget. We can see the percentage of people who listen via Spotify and other different means of listening to a podcast or watching it, and Spotify is still one of the larger ways that people, one of the most popular ways I should say, of listening to the podcast, where Apple is probably the biggest still. But do go and leave a review if you're watching, listening or whatever via Apple Podcasts, because we've not had a review on there for a while. But do go onto Spotify and leave a comment. I think it's a great way to interact with Andy and I on the show, and I go and reply to all of the comments. Even if it's just you giving a thumbs up, you'll probably get a big heart back from me. So please do carry on doing that. It will help us with the algorithms on Spotify, and it's great to see that interaction, because don't forget, when we push these podcasts out, unless you respond, you email in or whatever it is, then we don't get that feedback, and we do love it. Also, don't forget to go onto YouTube. You can leave comments there as well. But talking about the podcast generally, Andy, we're going to do something different actually this week, and maybe a little bit more going forward. We're always conscious that we're putting in so much content onto the shows to give you as much, well, I would say value for money, but you don't pay because it's free. So we give so much content on the shows that we do want to make sure it's got that right balance of you and I talking, as well as the value that we give in terms of the expertise that we give out on the podcast. So what we're going to do is probably start doing maybe 2 main topics on the podcast rather than 3, and that will give us more time to delve deeper and you and I talk around them. Also, next week, I'll just point out, saying we're doing things differently, there is going to be a special show with a special guest, so listen out for that next week, and I'd love to hear all your feedback when you get that on your podcast feeds. Do please make sure you leave comments as I've suggested. So on that note, Andy, I'm going to tell you what's going to be on this week's show. So we're going to focus on 2 big decisions that occurred this week that are going to impact pretty much every listener of this show and millions of people out there. So the first one is in relation to the mis-selling of car finance. So there was a big decision made by the Supreme Court. I want to talk about that, but also the whole mis-selling of finance, that scandal, because it's a little bit confusing as to what's going on. Are people going to be paid out money for car finance deals that they were missold, or are they not going to be? Is there going to be a compensation scheme? There's a nuance to the decision, so I want to explain that to people, because yes, there is likely still to be compensation paid out to people. And of course, there was the Bank of England rate decision this week. The Bank of England cut the base rate from 4.25% to 4% as expected, but there was something within the minutes that caught the market by surprise. So we want to talk about the rate decision and what was contained in those minutes and what it actually means for listeners, people with mortgages, and maybe savers as well.
Yeah, so I don't know whether it's good news or bad news for listeners that there's probably going to be a little bit more of me in the podcast, giving my opinions on certain things. We always, when we started this podcast, I mean, it's always done on the basis that we had one expert and then one guy who basically didn't know much. He just knew how to essentially produce a podcast. But that has changed over the years, where I began working for Money to the Masses. I had an insurance background. I wasn't so much on the investing side, but having worked with Money to the Masses now over the last few years, I do find myself hopefully a little bit more in the know and able to impart some of my knowledge. But so it was a different dynamic a few years ago. It was me asking the stupid questions. Maybe it'll be me asking the stupid questions again, but hopefully with a little bit more insight. Anyway, we're going to start with the first piece of this podcast. And so we're going to be talking about that car mis-selling scandal and recent decisions that have been made by Supreme Courts. Damien, fill us in on what's gone on, and maybe we'll chat a bit more about it after you've filled people in.
So with 90% of new cars being bought using car finance, the car finance mis-selling scandal had the potential to cost the industry billions. It's going to probably cost them billions anyway, but we were looking at a cost of around about £40 billion. So there were plenty of people within government and within the finance industry who were concerned about what could happen. So if we go back in the last week, there was a key decision that was made in the Supreme Court, a ruling on a number of cases that had a potential to significantly impact the redress that the finance companies would have to pay out. So the Financial Conduct Authority, which is the regulator of the finance industry in the UK, was waiting on that Supreme Court ruling before it then consulted potentially on a redress scheme for the car mis-selling scandal. So the first thing to point out is that there are two different types of mis-selling that have occurred and that are being looked at. So the distinction is quite important. I think with the headlines it sometimes gets a little bit lost. So the first one, which is the main one that anybody listening to this show will be probably focused on, is the mis-selling in relation to discretionary commission arrangements. So they're called DCAs for short. So this is where car dealers or brokers could increase the interest rate on the loan that was being offered for you to buy the car via a PCP arrangement in order to boost their own commission without telling you. So this applied to about 40% of car finance deals taken out before the practice was banned in 2021. And as I said, it includes PCP contracts, but it also does include hire purchase as well. So just as a reminder, for PCP is the deal where most people will pay a deposit and monthly installments, but at the end of the term, they have to make a final balloon payment to actually own the car. That's the typical way that a lot of people will finance a new car. So just to give you an example of a PCP deal where this was used, that was brought to the Ombudsman previously, there was a lender who was willing to offer an interest rate of 2.49% on the PCP deal, the finance that was required, but the dealer set the rate at 5.5%, which was the highest that they were allowed to under their discretion, to simply maximise the commission that the salesman would get. And the Ombudsman ruled that this was unfair and ordered compensation. So this then opened the doors to this wider mis-selling scandal, which the FCA was then looking into. Then we got the second type of mis-selling that was being looked into, and this is one relating to commission disclosure. It was a much broader issue, and it was argued that if the lender didn't tell you about any commission being paid to the dealer, then the agreement was unlawful. So this was the subject of the Supreme Court ruling last week, and it was looking at a number of cases that were brought from the Court of Appeal in relation to commission disclosure. Now, the court ruled that simply not disclosing a commission payment isn't automatically illegal. However, in one specific case they reviewed, the relationship was deemed unfair because the commission was excessive and it was 55% of the total cost of the credit. So this is a crucial detail because it leaves the door ajar for compensation on some non-DCA deals where the commission was outrageously high. So this was completely separate to the DCA scandal. So for most listeners, that is what they're really concerned with. So that leads me on to the biggest news of all, which was in response to the court's decision, because as I've already mentioned, the FCA had to wait to see what the Supreme Court decided because it could impact what they would do going forward. The FCA has now announced that it will consult on a formal redress scheme by October 2025. Now that scheme will definitely cover the DCAs, but it will also include non-DCAs where the commission was excessive following the Supreme Court's decision. Well, that's what we think at the moment. They are considering making the scheme retrospective, potentially going all the way back to 2007, which the industry is obviously balked at, saying that that is a long way and the records they have could be quite sketchy. Now, the FCA have said that shouldn't be a reason to not put a redress scheme in place, particularly for these DCAs that go back as far as 2007. The FCA estimates the total payouts from a redress scheme could be between 9 billion and 18 billion pounds, which would mean that most individual payouts would be less than £950. So the timeline for the scheme to launch and people to start getting paid really is going to be early 2026. So you might be listening to this thinking, well, what do I need to do now, if anything? So if you had car finance before the 28th of January 2021, then you need to work out if there was a discretionary commission arrangement in that particular car finance deal. You can do that by contacting the lender, and Martin Lewis has a really handy tool on his website which creates a template which you can use and email to the lender. You don't even have to know the details of your car finance, just who the car finance deal was with. So via a drop down, you can find the car finance company, find the details and where to send it, and then send it off speculatively, asking if you had a discretionary commission arrangement. I've personally already done this in the past and I didn't have one, and then that's the end of the matter. If you do have one within the same template, you can raise a complaint against the company. Now, that complaint will be registered, so it puts a line in the sand. But crucially, with the redress scheme that's coming in, it could potentially be automatic. So you won't need to put in a complaint. The car finance company will have to tell you, reach out to everybody who had a discretionary commission arrangement, and then pay them back the compensation owed, which will likely be the amount of the additional money that they paid plus interest. So that could happen automatically. So the good news is you might not have to do anything at all, but you could in the meantime reach out to the lender and ask if you had an arrangement, and then put in that complaint anyway as putting a line in the sand. Now, there have been changes to the rules when it comes to how those companies can handle those complaints, because there have been a whole load of them going to the companies because of the likes of Martin Lewis, who've made this very public. And so if you make a complaint, or you've already made a complaint, do bear in mind that there is a pause on the handling of complaints by these companies. So firms have until after the 4th of December 2025 to give you a final response, and the FCA will be consulting on whether that deadline gets extended. So if you've complained, you're in the queue and there's not much more for you to do for now. If you haven't complained, or you haven't found out if you've got a DCA arrangement which you could be owed redress compensation for, then reach out to them via that template. We'll put a link in the notes of the show. And if you did have a DCA in your car finance deal, or you may have had more than one, then you would have at least logged a complaint as well. But you could just sit there and do nothing for now. The one thing you definitely don't want to be doing is getting involved with a claims handling company. So there are plenty of firms that I hear on the radio and I see online trying to encourage people to get in touch with them to be able to put in a complaint to potentially get compensation for car finance mis-selling. If you do get involved with one of those companies, and let's say the FCA decide to have a redress scheme that is automatic and they just pay out anyway, then these companies will get 20 to 30% of your payout for doing absolutely nothing. If you've already reached out to one of these companies and you're engaged with them, then you do have an agreement with them. So the likelihood is you will lose 20 to 30% of any payout you receive. So there's an article on the Money to the Masses website that gives you all of the details of what you should do and shouldn't do. And as I've just mentioned, these firms are chasing people around the internet. I'm just hoping none of their adverts appear on this video or this podcast, because we don't have any control, obviously, on things like YouTube as well, what adverts appear alongside some of the media that we produce.
Yeah, I think it will be very likely, unfortunately, Damien, that we do, because I'm an avid YouTube user. I'm a YouTube premium member, so I get rid of all the adverts, but I know my children, this is going to make me out to be a really bad dad now. So I have the option of having a family membership, but it's double the cost. So I just have an individual premier account. And so I do see on my children's YouTube, when they're doing things, the odd DCA type advert popping up. So yeah, unfortunately, it's very difficult to escape them.
Yeah, don't use them. If you see adverts for these things, then just ignore them. But like you say, Andy, if you have YouTube, and I have YouTube at home and I don't pay for it, it's just use the free version. But unfortunately, the adverts you get are, I don't think necessarily personalised. I'm going to say my kids use the YouTube on our TV, and sometimes you're sitting there, and when it comes up with certain tablets for certain male problems that appear on the screen, I'm saying they're not targeted because of the type of adverts they are, but that's the problem. So we don't have control on the adverts that do appear. So if you do see any, don't click through to them and take a contract out with a claims management firm. So Andy, moving on to the next piece on the podcast. So the interest rate decision by the Bank of England. So we get excited at Money to the Masses Towers when there is going to be a base rate decision, particularly when it's almost certain there is going to be a change in that decision. So the market had priced in that there was going to be a 0.25% Bank of England base rate cut. So what I want to do is just talk about what happened, and more importantly, what happened in the minutes of the meeting afterwards. So where we are now, the Bank of England base rate went from 4.25% to 4%. And that means for somebody who's got a tracker mortgage, for example, for every £100,000 that they borrowed over 25 years, then they're likely to see their monthly mortgage payments fall by £13 as a result of that 0.25% base rate cut. Now, if you're on a fixed rate mortgage deal, then you're not going to see any change at all if you're still in your fixed period. If you're somebody who's saving, I can guarantee that you're going to start getting emails in your inbox flooded with the banks and building societies out there cutting the savings rates that they offer you, unless, of course, you're in a fixed rate bond of some kind. And while I'm making this show, no doubt my own personal inbox is filling up with those rate cuts from various banks and building societies. That, unfortunately, is just the way it works. So with the rate cut, then you tend to get a slight delay when it comes to the changes you see in mortgage rates. Not when you've got a tracker, it's going to be fairly quick, but when you're looking at other things, maybe an SVR, but also the prospective rates in the market for new customers, then they tend to not react as quickly to cuts in the base rate as savings rates. So banks like to cut what they give away to people in terms of interest, but they're very slow when it comes to giving back or reducing the rates that they charge people on their mortgages. Now, having said all that, when it comes to prospective mortgage rates in the market, this rate cut was priced in. And so initially, we might not see mortgage rates tumble or change at all because it was priced in. The rates you're getting on 2 years and 5 year fixes are taking into account the fact that there was going to be a base rate cut in August. So I wasn't expecting really any changes in the new rates that you see out there if you're looking to perhaps remortgage, for example. But what I'm going to do is I'm going to show on screen the market predictions of where the base rate will be over the next 5 years. The chart on screen has a range of coloured lines. Each line represents the prediction or the predicted path of the Bank of England base rate over the next 5 years at the date that the prediction was made. So there's a blue line on the chart. The prediction was made on the 17th of September 2024, all the way through January, March, July, and then we've got an orange line, which is the current prediction, the 5th of August prediction. Now, what you can see is that if you go back to September last year, so almost a year ago, the Bank of England base rate was already predicted to be down towards 3% almost, and then would stay there over the next 5 years. Well, that's been torn up. The market predictions do change regularly. It does show you have to take some of these things with a slight pinch of salt. But by January, the market was predicting that the base rate wouldn't get below pretty much 4.25% over the next 5 years. We are now at the stage where the market is pricing in that rates will continue to fall, but slowly. So by January 2026, it predicts there will be another base rate cut from here. So we're going to go from 4% to 3.75%. Then by January 2027, the base rate will be down at 3.5%. Then the prediction is that it will stay there throughout the whole of 2027 and 2028. And then in 2029, it will start to creep back up again to 3.63% by the start of 2029. And then by January 2030, it will back up towards 3.8%. And then it will slowly creep towards 4% throughout 2030. So you can see that rates are predicted to come down slightly, but not significantly. Let's now focus on the meeting minutes from the latest rate setting meeting. So the Bank of England has a monetary policy committee called the MPC. It's a 9-person committee, and they sit down and at each meeting vote about what the Bank of England base rate will be going forward. So the change to the base rate. Will it stay the same? Will it go up or will it go down? And it's a majority vote. This time, 4 people voted for the base rate to be cut by 0.25%. 4 people voted to keep it as it was, no change, but 1 person wanted the base rate to be cut by 0.5%. So there was no unanimous decision. So they had to vote again at the meeting, and that is the first time in the MPC's history that they've had to do a second vote. So that shows you how close the decision was and how undecided the Bank of England was about what it would do with the base rate decision this time around. So they did a second vote, and the person who voted for 0.5% cut moved on to the team of people who wanted a cut of 0.25%. So we ended up with a 5-4 split. 5 people wanting the 0.25% cut and 4 people who wanted to keep the base rate the same. So we got the unanimous decision, and the decision was for the rate cut of 0.25% to end up at a 4% base rate. That actually shocked the market because the market was expecting a rate cut, but I think they were predicting that it would be more unanimous than it was. So you got this weird term that was used, a hawkish rate cut is the way some people within the media are describing it. So a hawkish anything is something where the monetary policy is normally tightened. So somebody who's a hawk likes to tighten monetary policy, or someone who's dovish is erring on the side of maybe cutting rates. So this was a hawkish cut, which seems a bit sort of paradoxical, but it was a cut that was not as clean as people were thinking. And that was because the Bank of England mentioned in those minutes that inflation is going to hit 4% later this year. So inflation has proved stickier in the last month or so than they previously thought it would. So inflation, rather than peaking at 3.7%, as they had thought it would do, they've now said it's going to go to 4%. And as you know, the base rate is moved to try and control inflation in the UK. So when inflation goes up aggressively, they tend to increase the base rate. If inflation is under control and back towards that 2% target, don't forget they're targeted to keep it within 1% of 2% as the target, but they will tend to bring them down if they've been elevated as they have been. So if we get a contracting environment, so we start to get maybe the economy doing poorly, then they will cut rates to try and support it. So we're in this strange scenario where the economy is looking like it's perhaps weakening, but inflation looks like it's picking up. And they're saying the pickup will be temporary, but of course, if it doesn't prove temporary, then they may have to stop cutting rates. So the market reacted, and you can see this reaction. If you ever get a Bank of England base rate decision, go and watch what the pound does against, say, for example, the US dollar. So in the aftermath of the decision today, the pound jumped about 0.5%, which is actually quite a big move on a daily basis against the US dollar. So it's strengthened, and that's because with currencies, it's a comparison. They don't operate on their own. It's always versus another one. So the fact that the Bank of England was deemed more hawkish than they previously thought, it then meant the pound rose against the US dollar. So we're at the scenario now where there was a silver lining for savers in a decision. So there's a rate cut. If you're a saver, you're thinking, well, my savings rates are going to start to fall. I'm going to earn less money on my money in the bank. But the silver lining was that the market is now thinking maybe rates will stay a little bit higher for a little bit longer. And we'll put a link to our best buy tables on the Money to Message website, but it'd be interesting to see what happens to fixed rates next week and mortgage rates more widely, and to see if the recent trend that we've had where they've started to creep down, because you can get a 2-year fix now at around about 3.8%. So that's the best 2-year fixes if you've got a 60% loan to value. Whether that creeps back up again or whether we just see things stagnate. If I had to bet on it, I think we're going to just see rates stagnate for a while until the market sees what happens with inflation in the autumn. And then I think in the coming months, they may decide that the Bank of England might have to cut rates. Oddly, ahead of this bank rate decision, there were some commentators in the market. Okay, they were isolated voices. They weren't the consensus, that were saying that the Bank of England would have to cut the base rate quicker than they are. And into 2026, they would have to cut by perhaps as much as another 1 percentage point. So that is all up in the air. People have different views, but the market consensus is still that we're going to get more cuts into the back end of this year, but we'll see what happens in the coming days because that could potentially change.
Yeah, interestingly, as sad as it is, I don't really speak to my friends much during a working week. But the one time that my WhatsApp group seems to come alive is when there's a base rate decision. Everyone's looking at should I fix now or should, because it seems to be all of my friends at the moment seem to either be in the process of just about to fix or going to in the next few months. So yeah, it's interesting. And we've also done stuff on our socials that seems to be quite inflammatory whenever we do anything that mentions mortgage rates. One particular one that I liked was well, I don't know if you can, would it work on the podcast if you explain a meme? We'll put a link to it anyway.
We'll put a link, but there was a meme that just ticked over into the 1 million views. So we've done a few lately that have been viral. And one of them was a meme where there's a guy who's jumping up and down saying, like, oh, yes, I can't wait for this, oh boy, and he's excited. And the meme says, essentially, when you hear that the person or the smug person who's like, I'm on a 1% fix for 5 years is about to remortgage, because we've all had that person who's come round to your barbecue during the summer and over Christmas last year saying about, oh yeah, well we're on a 5-year fix, as if they predicted the market and they knew what they were doing. Sometimes the best decisions are a little bit down to luck. Well, that person's obviously remortgaging. Another popular meme has been the one based upon their reaction when they come off of their 5-year fixes and going on to the new current fixed rate deals that are out there. And funnily enough, there was a comment that was made on that meme that was incredibly popular, the one where it was kind of laughing at people who were being smug. And it's all tongue in cheek. And somebody wrote on there, which is a comment that made me laugh, which said, this is such a council estate mentality. And that tickled me. I mean, I did grow up on a council estate. I didn't realise it was such a derogatory thing to have done. And my mentality was biased as a result, but it just proves there's a million people out there who think just like me and do have a sense of humour.
Yeah, I am a 5-year fixer currently at the moment, and I don't need to fix for another few years yet. I'm looking about 2028, and with the graph that you shared, I'm quite interested to see how things develop over the next few years. I know it does change. Damien, your situation is a bit different to mine, isn't it?
Yeah, so somebody in Money to the Masses Towers asked me what I was going to be doing with my mortgage in the coming weeks, actually, that I'm going to have to decide what I'm going to do with my mortgage now that the deal's up. And I don't want to sway people because it's all down to individual choice. And early on in the year, I actually secured a new fixed rate deal. So I happened to get a deal with my current lender via product transfer, which had the best fixed rate deal at that point anyway. Now, I'm not going to say the length of the term because I don't want to sway people in their own decisions. But what I did was, by securing that, I still were open to changing my mind, getting a tracker or remortgage with another lender, but I was able to lock in at a rate that ensured that my mortgage rate wouldn't go any higher if rates started to pick up. And they did actually start to pick up through the spring and into the early part of the summer. We started to see them come back down again. So if you are someone who is on a fixed deal that's coming to an end and you want to fix again, then you can do that with your existing lender if they are one of the best deals in the market. Secure that, but you're not locked in technically, as long as you act way ahead of the current deal expiring and you have options still open to you. Now, always use a mortgage broker, as I do every time I go and remortgage or look at my deal when it expires. But somebody at Money to Masses Towers did ask me that question about, well, would I fix or wouldn't I? And my response to that question is, I look at it differently to some people. I'm not trying to necessarily have to have the cheapest possible mortgage I could at any given time. I weigh up both sides of the sort of the coin, really. So yes, if I got a tracker, because they said surely rates are going to come down from here, then I could get a cheaper mortgage if rates do come down. And this was ahead, don't forget, ahead of the decision that we had this week, where they then suddenly become worried about inflation a little bit more than they were previously. If for some reason rates got stuck or they started to creep up, that is also a major concern for me. I can afford my mortgage at the current rates that are out there. If I missed out on a cheaper mortgage for a couple of years, if rates did really tumble, then that is something that's, well, disappointing, but so be it. But if the concern is more that if rates rocketed or went up higher, then I couldn't afford my mortgage, which would keep me up more at night. And that's a very personal decision. So it's, when you come to looking at your mortgage, I would always say to people, you've got to do what's right for you, that you can sleep at night. You're never going to get the optimum decision unless you're lucky, in my view. So whatever you do, there's probably going to be a bit of balance in trying to sleep at night and make the sort of optimum decision that you can, given the information that you've got. So I haven't answered that question directly because I don't want to influence people with what I'm doing, but that's how I arrived at the answer. So I am comfortable that rates could do whatever they will do after I've made my decision based upon the information that I've got at this point in time.
And so that's it. We are done. A slightly shorter show this week. We are trying something a bit different. But before we do go, and I do need to get off, Damien, because my inbox is also filling up with lots of rate changes that I need to go and change on the site. But a really good way and a good segue into this next quick bit is a really good way to see what the best rates are, what the latest rates are, whether it's savings rates or mortgage rates. Do make sure that you use Add the Money tool. It's an AI guidance engine that you can ask any question you like. We'll put a link to it in the show notes. If you want to learn a little bit more about exactly what it can do and how it works, then go back and listen to episode 512 of the Money to the Masses podcast, where we showcased it. And as I say, this episode is a bit shorter, so use those extra minutes to go and check out themoney.ai. So that's DAMONEY.ai. Ask it any money question and I guarantee you'll be impressed.
And so that's it for this week on the show. Don't forget, go to Spotify, leave comments, whatever you want, emojis, it doesn't matter. Just make sure you do engage with us. Go on all our socials, whether it's Instagram, TikTok. So just because you might have had a little bit less content or topics covered on this week, you've got a lot of content, let's be honest, but a little bit less content covered, we cover loads on our social channels. So you can go through and find out all sorts of things on TikTok, Threads. I do love Threads at the moment. I put some insights on there. And go on our Facebook group, facebook.com/groups/money to the masses, and our YouTube channel. Of course, go on there, ask questions, leave comments, subscribe. All of it helps us. And also make sure you go to our newsletter and sign up to that. It comes out at 10 a.m. every Sunday with all the stories that impact your finances. So go to moneytothemasses.com/weekly-newsletter and you can sign up there and you can get the email every week, 10 a.m. and it even includes a roundup of the money sections from all the Sunday newspapers in there as well. So do go and check that out. So Andy, that's it for this week. I think all that's left for us to do is to say until next time.
Until next time.